Okay, brief intro. Two bankers, slightly different background. I'm ex-industry, so I started off with a proper job, P&G, and then I went to Clairol via Asia in textiles, and then for some reason got into banking and had a specialist boutique firm which I founded, which is called Baylor Klein. It was in beauty, personal care, so I know a number of people around the room from those days. And then I joined Houlihan pretty much last summer.
And my name is Chan Wang, part of the team for quite a long time now. Similar background to Tim in the sense I was part of a boutique called McQueen. Team of 25 bankers, got acquired by Houlihan Lokey about 7 years ago. So I think having gone through M&A transactions ourselves, we've got a bit more sympathy when it comes to process. And I'm also a Chinese national, so it's quite interesting observing e-commerce developing in China as well.
And then just 2 minutes on Houlihan. Houlihan is a very fast growth investment bank. It's actually the leading bank for transactions up to $1 billion enterprise value around the world. If some of our competitors are in, they might get a bit noisy at this stage. But what does that mean? That means that we do about 600 transactions a year. We're in about, I think, 17 different countries around the world. So we're strong in Asia, strong in Europe, and strong in the States. And increasingly, we're focused on sectors. So we are part of the consumer team, and that means that we cover pretty much all the consumer verticals from pet food, as per earlier, nutrition, and food, drink, beverage, and then beauty, personal care.
And I think we are now the most active investment bank by deal volume globally. I think number one is the 2021 data, which is, I think
it's quite a lot of deals. Yeah. Okay, so we have a few slides for you which range from a bit of context about the market, about DTC, and then just the things that we've seen in businesses that we've had the privilege of working with that have led to greater value being generated in the transaction, if that makes sense. So current market, bit tricky, actually, to be honest. So just as trading's tricky for everybody, there's been a little bit of a slowdown in value, both in the public markets, you've seen that, but also in some of the transactions values. There's massive interest still from investors. There's still a wall of investment funds available, and so good assets will still receive funds or achieve an exit to a trade player. There was a big fear of Amazon a few years ago, so companies with a high percentage of Amazon sales would raise an eyebrow or two from investors or even trade exits, but that seems to have settled down a little bit as people have become more familiar with the value of the Amazon channel. But so we're expecting a good year for transactions, not quite as strong as last year, which was a record year all round. So we had a little rustle around in the DTC sector. We identified a number of transactions, DTC transactions since 2017 to today, to get a feel for who is transacting in the DTC sector. Now, any statisticians here will say that 166 is too low. There's been nearly 400 deals in the DTC sector. But we put a filter on it and said DTC deals of sort of prominence. And the first thing that this chart shows is that actually last year was a massive year, 2021, huge number of transactions. But also quite interestingly, there's a fairly even split between those deals that are getting done by private equity or institutional investors and those that are going to trade. So it's pretty equally split across each year. And then by geography, there's an awful lot of transactions taking place in the UK, Germany, but also France, Nordics, Benelux, as you might expect if you read the press. And then by category, again, pretty broad spread. So we're very focused on our particular sport of interest, which in my case happens to be beauty, personal care. But I can see that home and garden occupied 12% of those deals done in the DTC environment.
And partly the reason I think the label is missing, so food and beverage, which is quite a large percentage because it includes pet, as we know is very active, and also VMS, as we know from previous presentation as well, which contributes to quite sensible percentage.
So unusual for bankers to be stating the bleeding obvious, but it's an incredibly active market pretty much across all sectors and all geographies. So the So what's really driving these deals? And I think the common theme between both trade buyers and private equity investors is people are looking for growth. So the big global majors have found some of the traditional channels, products, and categories that are a little bit slow growth. And of course, they need to keep serving up growth to their investors. And so they're always on the lookout for new brands that they can grow faster with. And surprisingly, or not unsurprisingly, financial investors themselves are looking for new brands that they can invest in that they then can sell on either to other investors who are more experienced at taking the brand onto a bigger platform or maybe IPOing or selling hopefully to trade. The reason for saying hopefully to trade is trade buyers often pay the highest values. I think that's it really. Yep.
So on this page, I think, as you might know, valuation is an art, not science. I think there are many factors when people, including both trade and financial investors, when they look at businesses, they're sort of taking into consideration to form their views. So on this page, we try to lay out these factors. So if we were to pick up the most important and differentiating factors from each of these sections, I think starting with the hard facts, I think revenue growth is important. Some investors have got minimum, say, 50% year-on-year growth as a threshold. Also, of course, gross margin is important. I think one of the reasons why investors are interested in D2C is because it's higher margin. You don't have the retailer in the middle. Moving on to operational, I think, CAC LTV, as we know, act as a filter when it comes to filtering investment opportunities. And then I think on the soft side, what is quite interesting, I think we talked about community early, brand early. I think there are many D2C brands which focus on performance marketing. I think it's quite easy and tempting to go with Google and Facebook initially when you're building a brand to the first 5 or 10 million, thinking that, I invest £10, I get, £50 back, fantastic, I'm building a brand. But when you get to 30, 40 million, is that sufficient to build a brand long-term, above line, below the line? It's quite easy for early adopters to think, oh, I know the brand differentiator, what are the key benefits of buying from this D2C brand? However, when you slowly sort of penetrate to the mainstream, question mark, for your brand, think about, do you need to invest in the above line marketing as well? And I think finally, community, I think many people mentioned in the presentation today, is increasing of interest. Why is that important? Not the least that it drives acquisition cost low. Having referral, I think some of the people here, you might use referral already, or organic growth that drives acquisition cost down. With CPA increasing, the new iOS system, that's quite handy. And also I think it can be helpful in terms of driving retention, repeat purchase rate, engaging with your consumer. And finally, even NPD. It can be quite interesting insight as to what your consumers are looking for, and it feeds back into the ecosystem to drive the whole, CAC LTV game.
So one of the benefits of doing so many deals as a firm and having so many offices in so many different geographies is we're able to compare data from all these different businesses and just identify trends and characteristics that we then obviously will inform some of our thinking and advice and direction and guidance to people we work with.
I think this we're not proposing to go through. I think there's lots of sort of metrics on this page. I think as Tim was alluding to, I think if we were to work with a business, the beauty of having done many D2C transactions is we know what good looks like. So I think we can do the benchmark, from market trends, traffic, conversion, customer, and these are all quite important when it comes to assessing investment opportunities for potential investors.
It is quite one of the first things you learn in investment banking or M&A banking is that the rule of the precedent is so important to investors and also trade buyers. Is everybody's always looking for the comparable transaction, and therefore if you're familiar or close to a very near proximate deal that took place somewhere, and you understand the intimate characteristics of that deal and what drove value in that deal, it normally has a starting point relevance to whichever transaction you're doing with that relevant new business. One of the things to bear in mind is, in the end, a lot of these businesses are hoping to end up in global majors. And of course, all the transactions are relatively small in the scheme of things, even up to 300, 400, 500 million ticket price. And they're not, in my sector, they typically end up with the likes of J&J, P&G, Unilever, L'Oreal, etc. And there is an interesting observation we made a few years ago, that those global majors who buy most frequently smaller businesses seem to have the highest growth and value, often way beyond the market growth of the sector. And there is a theory that it's a very good sign to their investor base that they are constantly looking to refresh their portfolio and address particular markets in a new and fresh way. And so the names that you see regularly buying are the likes of L'Oreal, Unilever have been quite busy, but many of these are serial buyers and always looking for new investments or new assets to buy. So P&G were quiet for a number of years, but suddenly jumped back into the market last year with Native, I think, was one of the first they did, and then they quickly did 2 other deals in the space. And you think, well, why would a business with a market cap of 390 billion want to buy an $80 million a Native business, a deodorant business like that? And what they say is it's because that business had competencies that P&G don't think they can put together themselves, and therefore they want to buy and learn from that business that they're acquiring, which is, remarkable, really. But that's a regular piece of feedback and a regular justification behind an acquisition.
Yeah, and similarly, I think, Nestle is on the page. I think we've sold many businesses to Nestle, including Tails.com. And more recently, actually, we announced another transaction in Germany, sale of a business called Ankerkraut, which is a D2C spices business, actually moved into becoming omni-channel as well, which we'll talk about later. So I think, as Tim was alluding to, it's interesting that, these acquisitive strategic buyers, I think some of them have done, quite well.
There's one deal we did, which I think we talked about last time we presented, but it's still worth mentioning, is that we sold Decium to Estée Lauder. And that started off with a very small fundraise, actually. The business was turning over about 20 million Canadian, and we raised 50 million Canadian. And we ran a very open process with private equity and also trade partners, which is, again, quite unusual. But we thought we were looking for a marriage. Someone used the word earlier, whether it be an investor marriage or even a trade marriage. And the founder, it's a very tragic story, but very much fell in love with the idea that Estée were his future marriage partner. And so we took the money from Estée. They were very good partners. They left the business to get on. They didn't want to in any way corrupt or interfere with the culture of the business. They wanted to learn from the magic that was happening in the business. And the business grew many, many times. It grew over tenfold before, unfortunately, the founder passed. And then they had a decision whether they wanted to acquire the business. Now, the business has continued to grow significantly beyond that. I don't know if the growth of the business is public, whether it's been publicly stated, but not only did it become very profitable, but it became very sizable. So, over 20 times the original size at which they invested. So it's a great, great story. And it's a significant brand for Estée Lauder now. But the reason they do that is that, they saw great parallels with another business they bought, which also happened to be in Canada, which is called the MAC business, the MAC Cosmetics business. And they saw the same success and growth with MAC, but through traditional channels. Again, looking far out beyond your investment round, perhaps, and maybe part of the investment thesis for your investment partner is, well, who's going to buy the brand in the end? And it's really important, I think, to think about, right from the early days, in the end, who might you be the best fit with? Because, this is a snapshot of the cosmetics market and the cosmetics brands in the cosmetics market. And you can see that all the leading cosmetics players have many brands already. And in fact, there's a three-dimensional kind of look to this too, which is, left the natural cosmetics through to fashion or beauty driven cosmetics, and then there's mass price point and there's prestige price point. But then there's also a geographic overlay, which is, Europe, US, and Asia. When you look at all those dimensions, many of these brands that they have already compete in some, if not all of those markets. And so the question might be, if you're going to maximize your exit in the end, whose jigsaw are you going to fit into? And also, many of the houses have their own particular DNA. So one of the examples I give is that, Kat Von D is a very distinctive brand, and I just could never see Kat Von D going into Estee Lauder. Now, because it's got a particular characteristic and a set of beliefs and visual representation that doesn't necessarily fit well with that their particular house style. Now, that could be complete nonsense, but it's something I've seen over 20 years, is that there is no doubt there are certain brand clusters that you will be more aligned to in certain corporates than in others. So a few tips that we picked up over the years. This is one of the first things that Unilever said to me: we'll always buy a great brand even with just a good business, but we'll never buy a great business with a good brand. This is relevant to DTC in particular. We've sold a couple of DTC brands which will remain nameless, where perhaps the brand could be termed politely to be slightly immature, but the route to market connection and conversion is all super good, often run by techies who really understand algorithms and cohort data and how to optimize and maximize CPAs and CPCs. But the brand isn't strong enough. And we've seen increasingly amongst the client base, DTC-only businesses looking really to work very hard to improve the quality of their engagement with their consumers, particularly and also considering the question whether they should also be present on mainstream retail shelves as well, to endorse and demonstrate that the brand works in a self-select environment as well.
I think gross margin, as we mentioned earlier, I think depends on which product category. Say in food, I'd say 50% is a good percentage above to work on, and for beauty, it's a slightly higher typical gross margin. And it's something that once you set your price positioning, it's quite difficult to change your margin. And really, that's the synergized EBITDA or profitability that for example, strategics can be lifting from the business and plugging to their organization, and ultimately dictates, cash flow.
So we have one at the moment with a Chinese investor who's looking at one of our businesses we're representing, and very nervous about the gross margin only being 50%, because the ratios that they're working on in China at the moment is that they're having to spend 40% on of the sales line on driving the direct business in China at the moment. And in addition, they want fuel to also support other above-the-line type activities too. So if it's only got a 50% gross margin, they're already worried that they're off on the wrong foot in that market. Channels, critical, but understanding how your consumers are navigating your business. So if you are an omni-channel business, how are you using each of those different environments to recruit, retain, incentivize, and gift, and what role does it all play? Having a very clear articulation and evidence to support that how you engage with your consumers in a very conscious and deliberate way is really critical. And then some really less exciting but really critical facts. It's really important to have all these basic hygiene factors in place, making sure your intellectual property is protected. You've got 101 other things to think about, but at the end of the day, if you're trying to sell a business on the basis that, or a brand on the basis that it's going to be relevant in the States and you don't have your trademarks protected, then it's a bit of a snag, to say the least. People are quite important too, particularly with the DTC-orientated businesses. And I say DTC-orientated because more and more are being sold multi-channel. But the last few deals I've done in DTC in that shape, the buyers have left quite a lot of equity with the original founders. So ranging from 49% through to 25% on a recent deal, so that the founders stay in the business and remain incentivized and motivated to drive the success of the business in the future. Partly that's because they don't fully feel comfortable yet with the channel.
And here's just a recent case study, I think as mentioned early. CAC, or referral organic growth, is quite important, which this business in Germany did really well. I think 30% is roughly organic. Gross margin, again, without disclosing the actual information, was very good. Quite interestingly, as Tim was alluding to, some businesses are becoming omni-channel, more frequently. I think just as part of that journey of having multiple touch points with consumer and part of the brand building. But again, I think it's important to make sure that retail or non-D2C channel, the margin is good. Yeah.
And that's our time up.
Time up.